You ever feel like your investments are going up and down like you're on a helicopter ride? Well, watch this video. You're not going to get as airsick as you think you will. Welcome back. Hey, coming up on today's program, before you sell that loser stock, watch this. You bought high and you're underwater and you've been holding it for months and it's killing you. The question of the day, we want to discuss, how are you handling the frustration of holding on to a position in the stock market when you bought too high and it's just eating at you? We've heard questions from many viewers, including Jeremy, who ask about this. Welcome to What's Next with Money, is a program that holds the promise of second chances, strategies for growth and financial empowerment. So we're talking about loser stocks, and let me tell you, I have been there many times. I know where folks are coming from. I am a long-term investor of stocks, ETFs, mutual funds, and real estate. Now, currently, I don't trade options, but I have training in that area. So when I think about selling, I go back to an age-old question: why did I buy that stock in the first place? What were those reasons? What was my thesis? Well, after many mistakes, I started writing down the reasons for the stock purchase, and that really helped my investment muscle memory and understood the implication of when I might sell it. A great question many famous investors ask: would you buy, or would I buy that stock again? If yes, maybe the move to make is to buy more at a lower price to lower your overall cost basis per share. Now, if I put my CFP certificate hat on, I would say back to, what is that money for? Is it for retirement, mid to long-term goal? A short-term investing focus breeds anxiety, and I really don't invest in equities for less than a 5-year time horizon. I may have a risk account that I might trade more frequently, but for the basic core money, I have that longer time horizon. I have cash and other short-term money ready for near-term personal and business expenses and goals, as well as investment opportunities. I have a video for you also called Cash as an Asset, and we'll have a link to that. So here's some buy and sell considerations. Number one, don't buy on margin. Leverage compounds the hurt. If you really think you bought too high, you can sell the position to take a tax loss to offset gains. But if you still love the stock and the investment thesis holds, you need to wait 30 days to purchase it at that lower price if it goes down. This is the IRS's wash sale rule, and that's assuming it's in a taxable account. This does not apply to retirement accounts. Personally, I use limit orders for buying and selling. I set an acquisition price kind of on the low side, and hopefully I'll buy that limit order becomes a market order, and I'll buy the stock on a bad day at the lower price. I'd like to catch other people's panic. It could take even months to trigger. I have that long-term investment horizon. And I've even done this with ETFs. To me, it's like setting a trap to let the price I want come to me. Let the market serve you, not instruct you, says Warren Buffett. I buy on a step-down basis. Sometimes this is patient capital. So as that price keeps going down, I don't put a lot of money in at once. I gather my position as the price gets a bit lower to build up those lower cost points of ownership. And you can also sell losers incrementally if you want to get out of that. You could set a limit order to sell at a slightly higher price than is kind of happening now, because there could be a snapback rally that pops the price up of your loser stock, and you catch that with the limit order. Again, that takes patience, but it may work occasionally. No guarantees. I look at charts, I see how the stock is behaving over time, but I'm also look at fundamental analysis, the long-term developments in the company, how it compares to peers, and the prospects for the industry. Now, what about individual stock purchases versus a sector ETF? This may be a way to move away from the loser stock problem in a new kind of way that you've not considered. Sometimes I use sector ETFs, exchange traded funds, if it's a new field that I believe strongly in, kind of a fundamental analysis. For example, water resources, AI, artificial intelligence, or robotics. Here I believe in the thesis, the relevancy of these sectors as necessary and maybe growth sectors, but I don't have the time, or I choose not to take the time to research a particular company in that sector. And a sector ETF with dollar cost averaging, buying a little bit over time in this favored industry might be a great fallback position from a too high purchase of a particular company. And if you buy a particular company, you have company risk. And that's where you may have been underwater. You hold those potential losses. If you still love and believe in the power of that sector, you could pull off a little jujitsu move and move to a sector ETF and out of a particular company that may have caused you a little investment hurt. So you might also ask, does the investment pay a dividend? Do you get income while you wait? And if you really like that stock and it pays a dividend, you might want to reinvest those dividends, because the reinvestment, usually on a quarterly basis, will happen perhaps at those depressed or lower prices. You're picking up some incremental shares at the lower prices, building up your position. Now, a big CFP type question is, how does the position fit in my asset allocation? Am I overweight equities, sectors, market cap, domestic versus international, growth versus value? This is just another point of view, another screen to help you calculate and execute your sell decision. So rebalance. It's a smart move for your overall portfolio's health. And something I've learned the hard way, don't buy all at once. Start your position small. Let things settle. And when I've bought too much, too fast in a new area, I've generally rushed into the stock or even the sector to my regret. Now, here are 3 reasons to sell from a classic author of the book Common Stocks, Uncommon Wisdom by Philip Fisher, also recommended by Warren Buffett. So here are Mr. Fisher's key points. If your original concept for the stock or company purchase was wrong, sell. The company is no longer considered a top performer, sell. You have a better place to invest or use that money, sell. So buy with a margin of safety. You make money by staying out of trouble. Another point to sell on accounting errors with the company. This is big time headlines exposing perhaps significant company risk. If they can't keep their cash pulled together, managing their accounting, there may be more underlying problems in that company than you thought of. Here are some other reasons to sell. Management changes, governance issues, whistleblowers, illegal acts, ethics issues, environmental problems, the inability of the company to execute on its business plan, to build, distribute, source materials, manage supply chains. What about extra vulnerability to hacking issues? They just don't have their digital footprint pulled together. Negligence, their ability to handle risk. And are they taking on undue risk and too much debt? But if the company is good and does not have these or other issues, and your original thesis and instinct to buy may have been right, and if some of these areas show up as a problem and they're about the business of correcting them and putting in new people, new procedures, maybe asking for external audit opinions, etc., it may be an opportunity. Again, you may have bought too much of the stock at one price, making you very uncomfortable, or the market sentiment for the company was inflated when you bought it. And this can happen with IPOs, initial public offerings. So looking for valuation, price anomaly in good companies, is a possibility of an opportunity. And sometimes there may be some pain holding on to those positions. But if you know and follow a company or a sector carefully, and they've had some kind of incident that has caused the market to react negatively, and it's very fair because it's greed and fear in the market. I'll give you a couple of examples. Chipotle. A lot of their customers were getting sick based on certain types of procedures in the restaurants. The company not only changed management over time, but they would shut stores down and they instituted new procedures, even raising the pay of some of the employees. Facebook had a poorly executed IPO rollout. Very much negative news, but the fundamentals of the company may have been sound. These may create opportunity. And during the pandemic, we've seen a lot of volatility. Supply mishaps, international events, or weather could be causes of stock price pressure on the downside. So stay with us. In just a few seconds, I'm going to give you a great action item you want to write down. So be sure to hit that subscribe and like button, and please share this with your investor friends. Now here's the bonus point I promise. Buy right to avoid selling early. Don't sell all at once or in a panic. This says a lot about your risk tolerance and time horizon, and your time horizon might be a little too short. Choose your entry points. Have a variety of entry points, and have clarity on your investment goals. Watch our video, the first one we did actually, on financial insomnia. This will help temper you as you move through markets ups and downs, and your ability to tolerate the downs without panicking is a key to wealth building. I do not like to sell also just for tax reasons. I like compound growth and value investing. I embrace long-term time horizons and getting rewarded for letting a good business get better, and I get to share in that growth and that upside. I try to be clear in the purpose assigned to the investment and the job I want it to do in my portfolio. The great Harvard professor Clayton Christensen talked about job to be done in terms of corporate strategy with products and initiatives. The same thing can hold true in your portfolio. And if it doesn't perform, I have the option to sell patiently and carefully because I got in carefully. And best of all, my fallback position is I am diversified. And I do not have such a large position that I cannot sleep at night, even during a market downturn. Again, check out Financial Insomnia video. Remember, new episodes of What's Next with Money are posted on Thursdays. Thanks for watching What's Next with Money. More financial tips coming in future episodes. Hit that subscribe button and like.